Hello, everybody. This is Coach Weaver, and this is your class on Hard Money Explained. And this is a very important class because, believe it or not, we use a lot of hard money. And it's really important why and how and, you know, how it works so that you don't kind of get burned by the wrong hard money lender. So here at Fortune Weavers, we try to make sure we protect you. We have our own hard money lenders that give us the lowest rates. But at some point, you're going to graduate and you're going to have to figure this thing out. And whether you use ours or not, they can really hurt you financially or they can help you depending on the program you have. So the goal of today is to have you learn about the different types of hard money, look at a loan application, see loan docs, kind of see how that works out, and then to go out and do a deal so you can use hard money and really learn how it works. So here we go. So what is hard money? A hard money loan is a specific type of asset-based loan financing through which a borrower receives funds, most importantly, secured by real property. Hard money loans are typically issued by private investors or companies. They are not found at your Chase, Bank of America, Wells Fargo, or any of those types of lenders. They are generally private and they charge much higher fees because they're lending on projects that the other banks will not. And they're generally non-owner occupied loans or houses or loans on houses that need fixing or investment properties. So a hard money loan is simply a short-term loan secured by real estate. They're funded by private investors or a fund of investors as opposed to conventional lenders such as banks or credit unions. The terms are usually around 12 months, but we've seen them go as long as 2 to 5 years. This is short-term lending, guys. This is something for fix and flips. These guys make their money on churning, meaning they make their money on the points. So if you can get these things in and out in 4 months, they're going to love you. So that's the key, is you want this to be fast so that your hard money lender wants to continue to give you as much money as possible on these types of projects. So most of the time your loan is based on the property, not your credit. That's wonderful because not everybody has the greatest credit. Now what will hurt you are things like tax liens, a recent bankruptcy or foreclosure. There's always someone that will lend to you, but those things, especially a tax lien, for whatever reason, will hold somebody up from lending to you. So you might want to watch that one. All right, the loan is fairly secure if you end up defaulting. They protect themselves, so they will only go up to a certain loan to value in order to protect themselves in the event that you can't finish. They foreclose, and they're in a position of loan to value that they could go ahead and resell the property and make a profit, and they wouldn't lose. So just, you personally guarantee these. So at the end of the day, as long as they don't lose money, you're good to go. And points and interest rate will be determined by your verified experience. You got to show these guys you flip properties. There's 3 general tiers. There's your A, B, and your C. Your A investor has done a lot of deals. They can prove it. They can verify it. They're going to get the best rates and fees. The B investor has done a few deals in the last 24 months, or they can verify over the last several years, and they're going to get kind of the mid-range points and fees. And then there's the brand new green investor. And that person will get the highest fees because they generally carry the highest risk for these lenders, because when you're brand new, you can make the biggest mistakes and get lied to by contractors and all those things that would cost you to lose money, or realtors. Anyway, you become the highest risk, and so therefore you pay the highest fees. Here's a flyer back from right around the crash. This is my prior company I owned called Missing Link Financial. And these were the flyers we were putting out for hard money. 20% down, as you can see here. Okay, so that means if you were buying a property for $500,000, the max they would lend you is $400,000, and you'd have to put $100,000 down. And then they did this thing called ARV, after repair value. They'd give you 65% of the after repair value. So if you look at that, if the house was worth $1 million fixed up, they'd lend you $650,000. All right, you can see the points here are really high, 4 points. We've seen that decline over the years and become much more competitive. And interest rate 11 to 13. Rehab money taken in things called draws. Draws means you have fund control, and as you prove you do work, the hard money lender will have a side fund where they will reimburse you money out of a fund control. Now you're paying on that money, but they'll put it aside for you just so you don't have to use so much money to get jobs done, and hopefully do more than one deal with them so that they can have their investors' money working for them. Here's one of our lenders that lends with us. All right. This is Spyglass Lending, just one of the, I get marketed to every day. And you can kind of see here, they'll do loan amounts up to $1 million, 80 to 90% loan to value. They're doing refinance. That was kind of, they're always Spyglass is always trying to create something to differentiate themselves. So I appreciate that. You know, low interest rates. I would assume this is for their best investors. You purchase first, we refi you 5 business days later, even same day. Qualifications, 640 credit scores. So they have a credit score minimum for this program and 10 confirmed flips in the last 24 months. You have to be a serious investor to get the best rates here. 12-month term, which is very important. Never do 6. No prepayment penalty. So meaning that if you finish early, they're not going to ding you any amount of money. They're not going to fine you for that. 2 points, that's fair. $1,000 processing, I'd pay that all day long. So not a bad deal. Here's Louis Loans. It's just another guy at Markets. All right. And you can kind of see no minimum FICO required, unlike the other guys. You know, a lot of these guys say that and fund in as little as 7 days. That's very rare. Most of the time they need 10 days. So just know that for hard money. In most cases, $25,000 to $3 million. Very rare to get 25 because they don't make any money on it. So if they give you $25,000, they're going to charge you a lot of money. So anyway, so we do both non-owner occupied and owner occupied. So this person's a traditional lender as well as a hard money lender, very similar to our people over at Endeavor Mortgage. So 3 types of programs, very important to know these. One we don't see very much anymore, and that's the last column. But the first column and the middle column we see often. And what you'll see is you'll see the purchase type of hard money loan, where it's generally speaking, it's going to be 20% down. You're going to, obviously you have a loan to value of 80% at that point, right? Because you're putting your 20% down. So if you buy a house for $500,000, they're going to make you put $100,000 down, and they're going to give you a loan of $400,000. Then you're going to have to pay the points, the holding costs, and all those things, rehab costs. You got to have extra money for that. Traditionally, no fund control, so they're not giving you any money on that program towards your rehab. The point costs are generally 2 to 5 points, hopefully closer to 2. And they have these junk fees. Junk fees are things like processing, recording fees, underwriting, appraisal, $700 to $2,500 on average. And this program will carry the lowest rates, usually 8.5 to 15. Again, hopefully closer to the 8.5. And then the one most investors use, most flippers, is the ARV, especially if they're really good at getting low LTV deals. These are 10 to 20% down on average. Loan to value, 60 to 75% of the after repair value. Let me explain that. So what that means, if you're buying a property that's worth $500,000, well, let's keep it simple. It's worth $400,000. Let's keep it simple. They're going to lend you up to $300,000 or 75% of that fixed up value. Let me say that again. So if you're buying a property that when fixed up is worth $400,000 future value, they'll lend you up to 75% of that. So let's say you get a property for $250,000. They will lend you up to the $300,000. So you could buy it for $250,000. You're going to put, the 20% down. You're going to have some room for fund control. That's next. They do fund control in this program. And you'll have all of your money for rehab, most likely, to fix up the property. And you have very little money into this deal. They charge a little more for that because you're at a little higher risk, because you have less skin in the game. They still carry junk fees and a little higher interest rates. Now, the one over here, we just don't see it very often, but it's really intended for seasoned investors with long-term relationships with these hard money lenders and who find a really good deal. If you hit a home run, so let's look at this. So profitability, 40, 50,000 single, right? 60, 70,000 double, 80, 90 triple, 100 plus home run. If you hit 200,000, grand slam, and this is baseball terms. I like to equate things to sports. So if you find one that has $100,000 in profitability, your hard money lender will say, hey, well, that's a home run. We want to participate in that. But look what they're going to do. They're not going to make you bring any skin in the game, but they are going to charge you 4 to 5 points. They're going to still charge you junk fees and higher interest rates. You're still going to have to pay it. They're going to make you take that out of your end of the profitability. And the benefit is you don't bring any skin in the game. You brought the deal. They fund the whole thing. And you do what's called a 50-50 equity split, minus all those points and fees and all those things they sting you on. I've done this a few times. Didn't really like it. Would much rather have a gap investor. So practice being a great person who raises capital, and you never have to worry about all those high fees. You actually make less on an equity split. So anyway, that's the 3 programs. Hopefully that made that clear. All right. So documents you're going to need. All right, documents needed to get a hard money loan. So loan application, you're definitely going to need a loan application. Executed contract, you need the seller and you as the buyer, you have to sign the documents, make sure it's executed. Okay. Preliminary title report. This is the report that shows all the liens against the property, any type of things that are attached, child support, credit card issues, all those things that the seller might have issues with as far as their title, extra people on title that you didn't know about. That'll show up in the preliminary title report. It's called a prelim. All right, and then you have to show, if you're buying with an entity, that you have an entity that is good with the state of California, if you're in California, or the state you're living in, and you got to have articles or bylaws to prove that you have a legal entity in good standing. Scope of work, you're going to want to show that you have had a contractor out there that you can, you have a scope of work, kind of has a flow, makes sense, so they know what the rehab pricing is going to be. All right, you're also going to need your escrow contact info, right? So once you get a deal under contract, you're going to use escrow, make sure they have that information. You're going to want to get insurance as soon as possible. They're gonna want that. They're gonna want a specific type of insurance from your insurance carrier, and they may want an appraisal. So you got to get that done as soon as possible. And worst case scenario, they want bank statements from your corporation or your personal bank statements to know that you have some money in the bank. I generally don't use those types of hard money lenders because they're too nosy and they're too conservative for what we do. They're kind of these pseudo hard money lenders, but not really what we're looking for. So you're going to have some homework at the end of this presentation, and I'm going to want you to call some hard money lenders. And so these are the questions you're going to want to ask. You're going to want to have a pencil and paper ready for this. So I'm going to kind of pause here for a second, give you some time. Go ahead and get a pencil and paper or pen and paper. These are the questions I'm going to want you to ask. So I'm going to pause again for 10 seconds here while you get that out. Okay, so here's your first question. Do you lend on ARV? ARV stands for after repair value. Like we saw, the 60 to 75% of future value. Will you lend on that? If I find a good deal, that's going to reduce the amount of money you have to bring up front if they lend on ARV in most cases. Do you lend on ARV? Second question. Do you impound the rehab money? Do you have fund control, basically? If it's ARV, will you allow money to be put aside that you'll give me in draws as I fix up the property? And again, this just means you have to bring less money to the deal. In a normal hard money loan, you're putting 20% down plus holding costs, your monthly mortgage payments to the hard money lender, plus your rehab is coming out of your pocket or from a gap investor. In this case, you could use a gap investor with sometimes $50,000 and actually get a total flip done, where in most cases, without a situation like this, you're bringing in 2 or 3 times that. If yes, what's the process for receiving draws? And I'd also want to know, how much does it cost? I know some of these are $100, some of them are $200. each time you ask for a draw. So if you ask for 10 draws, that can be $1,000 to $2,000. I would highly encourage you to break it into 4 to 5 draws. Costs a lot less money. Number 4, how many points do you generally charge on a loan? Very rarely you're going to see more than 5. The only time they charge above 5 is on smaller loan amounts. So if you borrow 50 grand, they may charge you 5 grand in points, 10 points. But on our larger loans that are, we might even get as low as 1.5. It just depends. What are your typical interest rates? The lower the better, right? We've seen stuff in the 7s these days, on up to about 12. We used to be at 15 during the crash and all those years that followed. So it's become much more competitive. Believe it or not, a lot of people lost their homes, and a lot of hard money lenders went out of business because they started investing without any skin in the game. The money was kind of free flowing for everybody out there. And so a lot of the hard money lenders got caught up in a lot of projects that went belly up, just like traditional lenders did. And so when the crash happened, there was only a few hard money lenders in the business. And so they were very conservative, very strict, and they had, really high points and interest rates. So it's really competitive now, especially when we have low interest rates like we do. They're going to be higher, but just not that much higher. What are your junk fees? Remember, that's your underwriting, your processing, your appraisal. Don't call them those things. Call them junk fees so that they know that you kind of know the jargon. What are your junk fees? What do you guys charge for those things? Do you charge for an appraisal? Things like that. Are there any prepayment penalties? Hey, if I finish this thing early, are you going to charge a prepayment penalty? Most people don't. Most hard money lenders don't. So, that might be one you ask or you don't. And if I do several deals with you, are you wanting to give me a discount on my points and interest rate in the future? And do you have other programs for fix and flip loans? Do you have anything that's kind of unique, any kind of type of equity split? Maybe, if I find a really good deal, do you offer something better? Stuff like that. And this is really important. Do you have a fund or money pool, or do you work with private investors that back you? And sometimes they get a little weird when you ask this and you say, hey, well, the reason I'm asking is I've noticed that when I talk to hard money lenders that have a fund, like a hedge fund backing them, they don't allow us to bring in a second or a gap investor. And so that's what we've noticed. So we want them to be using private investors because that means we can record that second and bring in our gap guys. And again, I'm going to explain a gap. So let's say the hard money lender requires you to put 20% down. They're going to only lend up to 80% of the purchase price. So if I buy for 5, they're only going to lend 400,000, right? Now, I still need to bring in 100,000, plus I need my holding costs. Let's say it's 3,000 a month, plus I need to pay for rehab until I get this thing done and it sells. So let's say my rehab's 50,000, so I'm bringing in 150 plus points, plus fees, and plus holding costs, right? So you can see how that adds up really quickly. And so I'd rather have a second investor come in and fill that spot versus being forced to use my own money. Homework. All right, so what we're going to want you to do is I'd like you to write down these websites. I'm going to give you a minute or so to do that. And what this is going to do, it's going to have a list of hard money lenders. Check them out. You can Google hard money lenders in California as well, and you can call these people and ask them those questions. So go ahead and write those down. And then I'm going to want you to call 4 to 5 and just ask those questions that you saw earlier in the video. Go through, ask them. They get calls from new investors all the time, so don't worry about being new. The thing that frustrates them the most is when they come out of these seminars and someone tells them that they don't need any money to get a hard money loan. Over the years, that's the thing that seems to frustrate them the most. You have to have skin in the game, whether it be your skin or another investor that you are working with, their skin. But there has to be some money put into these. There's very rare cases and instances where they're going to do a zero money type of hard money loan. Those days are over. They used to happen a long time ago, but I don't think we'll see that ever again. Okay, let me give you a moment to write that stuff down. Okay, I'm going to show you some docs so you can kind of see what we're referring to. All right, so this is referred to as a 1003. And a 1003 is a standard loan application, uniform residential loan application. I don't know why it's called a 1003. All the loan officers call it that. And this is what you fill out to get a conventional or traditional loan from a bank or a lender. It's generally 4 to 5 pages long. This is 5 pages. It's going to ask you all of your liabilities, if you've ever been in trouble financially, basically, or do you have any bankruptcies, things like that. Ask you to list all your assets. Are you presently delinquent? Stuff like that. So this is what a traditional loan application looks like. Okay. A lot of work. Plus, when you do a traditional loan, you got to bring all the bank statements, tax returns, W-2s, all your verification of income and stuff like that. Some hard money lenders make you fill out one of these just to protect themselves under current regulation. So they want to protect themselves by at least having one on file. You just don't have to fill out all the stuff. You just kind of keep it real general. They just need to have one. You go to the next thing. All right, so here is, this is one I did with Anchor Loans, which is kind of a bigger hard money lender locally. Very competitive. And this is 5 pages that they wanted me to fill out under each of these categories: permits, demolition, foundation, for work to be done. All right, let me go to single page. So all the roof work, exterior repairs, windows, garage. And again, this is all the cost to it: interior carpentry and doors, sheetrock, paint, kitchen, bathrooms. 7 pages long. Lots of stuff here, right? Appliances, what do each of them cost? Total repairs. You're going to fill this out. Now, obviously, if you're new, you're not going to know what this stuff costs. You're going to have to run through this with your contractor, and hopefully he'll take the time to do it. Here's something really important, though. There's something called a lien waiver. And so what they're going to do is these are all things that should be subbed out in most cases. Each one of these is a different contractor. Sometimes, your HVAC guy is not going to be the guy actually installing your hardwood flooring or anything like that, right? And so your HVAC guy is probably not going to be your plumber either. So they're subs. So what you want to do is you get a lien release, so each one of those subs can't come back after you and put a mechanics lien against the property and prevent you from selling the property without them getting paid. So that's what that's all about. So in this, you would need to know a lot of information about what the repair costs are to get a loan with them. If you didn't fill this out correctly, they'd probably question you on whether you deserve to do a fix and flip loan with them. All right, moving on to the next thing. All right, let me show you an actual application. I kind of zoom in on that. So this is one we did in Monterey Park. Loan request timeline, I wanted 12 months at a minimum. All right, so you can kind of read through this. This is purchase price $390, ARV $550-ish. I always use ish just so it's in that range. Converting it from a 2.2 to a 3.2. I wanted to put 10% down, which is really nice. All right. Buying it as Fortune Weavers Inc. as sole owner. Been doing it since 04, 100 deals or so. This is one we did in 2013. So this is one I found that was in our files. All right. $150,000 to do the deal. And the thing I like about these guys, will you be using a third party for funds? Yeah. They were okay with using a gap lender and recording them in a second position. I just put anything down under there. These are some properties we owned at the time, right? And as a company, so it's good to see assets. Rent roll on those things, I just ignored it because I'd done loans with them in the past. Here's something that they're going to ask you, though. Do you have any judgments? Have you been declared bankrupt in the last 7 years? This could possibly prevent them from working with you, depending on how you answer this. Are you presently delinquent or default on any federal debt? Right? Those types of things. Child support, those things will haunt you. Any part of down payment borrowed? You could say yes. Are you a co-maker or endorser on a note? I don't know. So anyway, I left it blank. I don't answer that stuff with these guys because I've done so many loans with them. But you might have to. All right, and then what does it look like when you actually get loan docs? 47 pages. Let's go to single page. We'll go back up here. Obviously, I was looking at it. So this particular one was with Winvest Capital. Again, this was done in 2013. So you can see they charged, probably 2 points, 10 grand. They charged an appraisal fee. And they gave me almost $10,000 in fund control, or like a rehab fund. But most of this is just kind of legalese. Balloon note. Let's see, and you got to personally guarantee this. So these things, you have to be real careful when you do it. Normal deed with a balloon rider. Again, just a bunch of legalese and ways they can come back after you if you screw up. You gotta make sure you have the right insurance on the property. This is standard. Just look at this, 40-something pages of this stuff, guys. All right, let's see. Let's see if I can find some financials for you so you can see that. Again, this has me on there as president of the company. Balloon rider, great. All right, here's some financials. Let me see if I could expand that. All right, here's your mortgage loan disclosure statement or good faith estimate. They charged me $9,847.50 in points. They only charged me $495 for appraisal. This is my interest. All this normally would have fees that they could charge. If I was a new borrower, brand new, right, they would have charged me a bunch of fees in here, a bunch of junk fees we call them. My interest rate's 11.9, total loan amount $328. Remember, we bought this thing, I forget what the purchase price was, but that's the loan amount. So if you figure if the loan amount's $328, they're charging me 3 points on this in 2013. All right, almost 12% interest. All right. Title insurance, notary, all this stuff, other closing costs, that's normal stuff. Title charges $900. So $16,273 in money that you got to bring to the table just to close it on top of, your down payment. Let's see if we have any more information here. Payment monthly $3,282. So you got to factor in 6 months. So I'd have brought in about $20,000 just in case, I held it for 6 months. And then if you go 7-8 months, you're either paying out of your pocket or you got to borrow some more money. And then there's just the Patriotic Act stuff. But that's pretty. Let's see what that was. I like looking at. So here's as an APR 15% because of the points, right? So that's what. Remember when we're looking at this, you just got to look at okay. If I'm paying somebody 12%, here it's 3 points. Now it's changed. It used to be that if I had an all-cash investor, a private money lender, they were way better than hard money. But because now we're getting hard money in the 8s with 2 points, APR is much lower. It's lower. It's usually lower than 12. So it doesn't matter whether you use a private money investor or hard money. I'd rather even use hard money. It's just more simple. All right, so that's what I wanted to show you. I'm going to jump back into this and kind of leave it there. So hard money is something that's real important to learn about because you're going to use it in most cases. Some people don't. I do. I love it. I've been using it for years. I can take an investor with $500,000 and do 4 deals with that money versus 1 deal. So let's say I lose $5,000 of profitability on each deal. So if I were to do 1 deal, I would have made $50,000. So on each of these deals, I'm making $45,000, but I'm doing 4, right? So $180,000 of profit versus 50. It's a no-brainer. You do more deals using hard money with that gap money. All right, that's all we have for this class on understanding hard money. If you have any questions, go ahead and email us at help@fortuneweavers.com. We'll see you on the next one. Thank you.